Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. It's April 26th. It's a hump day. It's Wednesday, and it's my mother's birthday. My goodness, I got to call her, wish her happy birthday. Anyway, it's about 7:25 in the morning. The market's going to gear up to open up in 2 hours and 5 minutes. As you can see here, I'm nice and early here for you because you guys want these videos nice and early. Now, as you can see here, Nasdaq is up about, almost 100 points. It was up 100 points, and the Dow's down about 55 points. We had earnings yesterday from Microsoft. They were really good. And the stock is up about 7%, and it has a big market cap in the QQQ. The problem is Google also had earnings yesterday, or Alphabet if you want to call it, and the stock is down this morning. So from what I could tell, the only major stock which has a lot of market cap is the Microsoft, which is causing the futures to rally pre-market. So don't let that distort you, because one stock can't drive the entire market. Seasonality is supposed to improve going into today. So the markets theoretically, based on about 15, 20 years of data, are supposed to be firmer than usual. And volatility looks like it's coming down a little bit. So we could have an update today. Keep your eye on the Dow Jones, because it actually doesn't have a lot of technology in it. And if Fed data, which we're going to have in just a little bit, in about an hour and 4 minutes from now, you've got durable goods and international trades in goods and services, and you also have the petroleum report. That's going to be coming out in a little bit. Looking at the bond market, it looks like we're still headed higher, which means long-term interest rates are cooling off. But the odds of the Fed raising rates lower than 0.25, or basically not raising rates, is about 15% at this point, and the odds of them raising rates is about 85% at this point. So I wouldn't be focused too much on the 10-year. If you really want to know the direction of the Fed, I would be looking at the 1 to 3 year, and that jumped a little bit, but not nearly as much as what we saw from the 10-year. The bottom line is, as the markets soften up because earnings are bad, interest rates are going a little bit lower because there's a less chance that the Fed will take higher action if the numbers are weaker than expected. That's the reason why the bond market is rallying. Now let's talk about the nitty-gritty, and then we'll get into sectors and all the things that we like to talk about technically. So solid earnings from a couple of U.S. tech giants boosted market sentiment, but Google's already down. It was up 1%. It's already down. And Microsoft is the only one that's keeping us up right now, which means we got a lot of vulnerability unless the rest of the market picks up steam too. So Microsoft climbed over 7% in pre-market trading after the giant reported upbeat third quarter results, suggesting strength in the AI and cloud business. Google also said it had good results, but the stock can't keep it up. It's actually down, as you could see right here. I showed it to you a second ago right here. It's already down. It's not even up right now. Look at that. It's up 1.4. So it lost yesterday. It's down today. And I would be careful, because if a stock has good earnings and it's already down the day after, and Microsoft is up, Google should be giving it a good companion run, and it's not right now. And they announced increased buyback, and it still can't get up. So that's a big problem. In Tuesday's session, markets closed sharply lower. And I remember somebody telling you that we're going to start a deceleration period. And I was even showing you all the sectors that are overbought a few weeks back, like all the sectors that are not skyrocketing right now. Benchmark and blue chip Dow Jones notched a 2-week low, and a tech-heavy Nasdaq 100 fell to a 3.5-week low. That's almost a 1-month low. Weakness in regional bank stocks weighted on the broader market, with First Republic Bank tumbling over 49% after the bank reported a bigger than expected decline in deposits. But while that happened, let's take a look at financials and see how they did yesterday as a whole. Yeah, they were down. They were down about 1.72%, while the Dow was down 1%. So a little bit more than the Dow, but you could see very similar trading action to what we saw yesterday. And there's a good chance we will rebound if the Fed data is better than expected today. Now, United Parcel Service, UPS, plunged over 9% as the company reported downbeat first quarter results and expects full year revenue to be at the lower end. That's a big transports type of a company. That's a company Americans use. That's not a good sign. I wonder if FedEx is going to come up with similar numbers. Economic data on Tuesday showed that consumer confidence dipped to a 9-month low. Folks, that's not a sign of a recovery. That's a sign that we're going into a recession. Weaker than expected of 104. On the earnings front, oh boy, we got Meta, we got Thermo Fisher, we got Boeing, we got AMT, we got ServiceNow. Matter of fact, let me show you all the companies. And by the way, Meta, who's coming out today, they're expecting $2.03 per share, which would put them at negative 25% year over year. And revenue is pretty much flat. Revenue has been coming out a lot better than earning than the EPS, but I'm an EPS kind of guy. Money's money coming in, but what are you keeping afterwards, right? That's the big key. And they're earning 25% less than a year ago. And here's all the other stocks. ADP's coming out, Avalon Base coming out, Avery Dennison coming out, Boeing, as I mentioned, Churchill Downs, CME Group, eBay. I mean, you name it, it's coming out with earnings. UQT, General Dynamics, Hell American Pain, Hilton, Kalac, Mattel, Molina, Orly. I mean, you name it, it's coming out with earnings today. I mean, literally. Look at this list. Look at this list right here. Teladoc. Let's see what else. Thermo Fisher, as I mentioned. United Rentals, that's a pretty big one. Wyndham Hotels and Resorts. Keep your eye on the hotels today. Spirit Airlines is coming out. Roku's coming out. Raymond James is coming out. Pioneer, this is a pretty big stock. Penske Auto, they sell cars around here. O'Reilly, O'Reilly's coming out too. Hilton's coming out today. 2 hotel stocks, so we got to keep an eye on hotels. And so a lot of companies. We are deep into earnings right now. Now, looking at the S&P graphically, which we'll do right now, short term, it's overbought. Now, I'm actually expecting the market to cool off, to heat up a little bit the next couple of days. This is a little too much for the S&P. And if you look at the 5-day RSI, which is actually better than the 10-day for shorter term moves, it looks like we're a little bit overdone. And usually when we get to these levels, we tend to come back up. So unless today's a really nasty day and we break through this support level, I think we're going to see a little bit of a reprieve to the upside because momentum levels are getting a bit low. Now, speaking of momentum levels, I hate to say I told you so, but remember when all of this was green and you had consumer discretionary at 100%, you had consumer staples at 100%, you had information technology, which is now at 8%. This was at, let me show you this. You got to see this. Look at that. It wasn't that long ago that we were up here at 98th percentile. It was 26 days ago, and I told you this thing is going to come down, and it hasn't been this high as far as COVID. Look at where it is right now. So momentum levels have come down quite a lot. Communication services at 17%. Momentum levels are not overdone right now at all. They're actually pretty reasonable right now. Information at 8%, consumer discretionary 55%, communication services at 17%. They're definitely, look at that. They're definitely on the way down. So we're not really as overbought with the Nasdaq making a 3.5-week low. I told you that was the high when we came up here, and it was. It was about 3 weeks ago. I told you, and I was 100% right on that. That's another reason why you're seeing the bond market climb, because tech stocks are cooling off. When tech stocks are cooling off, it puts less pressure on interest rates. So again, with techs cooling off, the Fed will less likely to take action. But that's one of the biggest factors we're seeing. So there is definitely a negative correlation between techs going down and bonds going down. Because again, as the tech goes down, the Fed is less likely to take action, which is why the long bond is moving higher. But I think we're going to get a reprieve. I don't think we're in a downward spiral unless the Fed data, the durable goods and international trades in goods and services, comes out really, really nasty. Now, looking at the sectors, remember what I showed you, technology, communication services being in the top spot, consumer discretionary being here. It didn't make any sense, and it still doesn't. But look at where right now communication and these two, they're at 8% and 7%. You've got consumer staples just waiting to take their spot off. And if you look at it on a monthly, you will see utilities, energy, consumer staples, healthcare. That's what should be leading right now. Communication services, consumer discretionary, technology, This industrial has to move up back to basic materials. But based on what I'm seeing, 2.29 versus 2.27, that's like 5-minute move in the market, and they will switch place. And then you will have consumer discretionary, technology, and communication services together. Remember what I always say, they get out of whack on the way up, and they become fragmented on the way up, and they become defragmented on the way down. So that's something we're going to be paying attention to over the near term. Now, let me continue this. Today, all eyes are on the durable good orders, good U.S. good trade balance, crude oil inventories. Now, Asia's keying off of U.S., and they're really paying attention to what we're going on here. Losses in tech stocks led the market lower. The correlation between U.S. stocks and Asia, and Europe is very high right now. China. Let's highlight China in blue. Composite closed lower. Slight geopolitical tension continued to weigh on sentiment, while market participants were cautious ahead of the upcoming Golden Week holiday. Man, they have interesting names. A group of 9 Republican senators urged Biden administration yesterday to impose sanctions and take other actions against the Huawei cloud and other Chinese cloud service providing, citing national economic security concerns. That'll be very, very interesting. And in Japan, they retreated lower from 8-month high amid renewed concerns about global banking crisis and possible U.S. recession. I'm not as concerned about a banking crisis, but I am concerned about a recession. Pre-markets, you've got Enphase plunging 15%, Chipotle up 7%. I've never eaten there. I got to try it sometimes. And Scott Miracle-Gro down 1%. As I mentioned, what is not having earnings today, right? What is not having earnings? Just about everything. Now, let's look at sectors so we can make heads and tails of what's hot and what's not. Utilities is still moving higher. I like utilities. Energy had a little bit down day yesterday because of the economy, but I think it'll spruce back up. Look at consumer staples. I warned you that consumer staples, when it was down all the way to the bottom, that this thing was going to take off. Healthcare is starting to kind of get a little choppy, and I think it's a little overdone as well. Communication services needs to cool off. Basic material looks nasty. Financials looks like we're having another bit bad ride. Real estate doesn't look so great. Technology and consumer discretionary, definitely not. Industrial and basic materials, I think, will bounce. I would be careful with consumer discretionary, technology, and communication services. That's one of the reasons why I bought the Dow yesterday instead of buying the Nasdaq, because I'm really nervous, and the Dow has less exposure of tech stocks, which we got to be really careful. And from what I'm seeing, the only one that gave us a surprise is Microsoft, and one stock, maybe Apple, but Microsoft can't drive the entire index. Again, utilities, energy, consumer staples, that's where I would focus right now. Now, let's look at stocks that I would buy and stocks that I wouldn't pay a penny for. And I'll do both the long side and the short side. So looking at the modified CSI scan, which we like to start with, these are all the strongest stocks right now. Now, First Solar is looking really good right now. Sands is not. Lamb Weston's still looking pretty good. PCG's looking really good. GE had earnings which are actually pretty bad. I still like Win quite a bit. I like Pulte Group a lot. But in my humble opinion, now let's look at my 20-week high list. I like my 20-week high list. Let's take a look. Merck is looking really good. Edison, yeah. So far, from where I'm seeing, honestly, I like this one. Here, let me. What am I doing here? Here. Too many buttons to click. That's the problem. Honestly, I really like the First Solar. It's got a nice little pullback, and it looks like it's going to pull up. I would be buying calls in June right now on First Solar, FSLR ticker symbol. They shouldn't be too bad either. Now, to the downside, and I would, if you want to put a stop loss, I would put a stop loss right below this level right here. That way you get plenty of room without knocking the support level here. But I like the support, and I think it's going to bounce back. And the fact that it closed higher yesterday is a good sign. Now, I'm not doing earnings. If it's got earnings, I would wait for earnings to come out about 3-4 days. But I like First Solar, and it is a very strong stock right now. Now, to the downside, oh, I love doing the downside. To the downside, what did I say yesterday? Generac Holdings. I'm pretty bearish on Generac Holdings. Match made a new low as I expected it to. VFC. But my suggestion right now is Generac, GNRC. I think this is going to break lower and go to the 90 from 100 to about 96 level. So I would be buying June puts on GNRC right now. Again, I'm assuming they're not coming out with earnings. I didn't do an earnings scan. But GNRC would be my weak stock. And what was the other one here? for solar, which happens to be the second strongest stock right now on Wall Street, according to my scan, I would be going long. So I'm not really violating my rules too much. Now, before I let you go, and by the way, I hope you like this channel. This is if you don't know where I post these videos, go to YouTube, type in Wealth Press. It's in the YouTube Wealth Press channel. I post them every day as early as I can. And I love to give you guys these trades and these ideas. I'm doing it every morning. Like the channel, subscribe to the channel, and you'll get notified every time the video pops up before anyone else gets it, before I even post it on Telegram, or before Clyde, wink, wink, posts it on Telegram. So like the channel, subscribe to the channel, and also subscribe to Telegram. Now, before I let you go, I've got something really big for you, something important. Celeste Lindman just created a brand new indicator designed to help protect you guys from all the BS out there. That's right. This new indicator shows potential entry and exit points and can even help investors cut through all the noise and trade with less emotions. There's no complicated patterns, no guesswork, and no BS. Now, Celeste is holding a special live presentation to reveal her new indicator at 1 p.m. Eastern Time today, 26th of April, my mom's birthday. I'm going to be there checking it out. I can't wait to see this. Follow the link below. Check out her free presentation. Do it now. Don't delay. Don't procrastinate. And again, the link, if you can't find it, it's in the YouTube Wealth Press channel under this video with all the other cool links that you should subscribe to get all the free stuff, pictures of my cats, free trades. Notice I said pictures of my cats before I said free trades. But all the good stuff. Seriously, folks, you don't want to miss out. It's going to be very, very cool. 1 p.m. today. Stop with all the BS and get the no BS indicator. I mean, this name has got to be my favorite indicator, the no BS indicator. I'm going to get the no BS indicator because I want to use something that has no BS. There's so much BS on Wall Street. The last thing you need is another regular indicator. This is the no BS indicator. Follow the link below. Check it out. Celeste is red hot. You don't want to miss what she's got to say. And I'll talk to you guys later. Any questions, concerns, comments, and feedback, send me an email, support@marketgeeks.com. Bye, guys. Have a great, great day ahead.